Jeffrey, great to get you back on Real Vision. It's been a while. I think the last time we spoke was with Grant, and it's really good to have you back.
Yeah, it's good to be back. It's been a long time, as you say.
Yeah. So I would love, for the benefit of people, you've had an incredible career, and I'd love to hear, if that's okay, just some of your career, how you started and how you got where you are today. Because, a lot of the time you get interviewed for 3 minutes, and it's really good to hear, how you think and what you do to get to the conclusions you get to.
Well, I got into the investment management business by accident. Actually, I didn't know what it was. I didn't really have a career going. I was trying to find myself. That was when I was in my 20s, early 20s. And I saw a TV show that was called Lifestyles of the Rich and Famous, which is by this guy named Robin Leach. And I never watched the show. It just happened to go on. I had a TV set. It was black and white. It didn't have a dial on it, and he had pliers to turn the station because it was all beat up. And I had a wire coat hanger for an antenna. And I only got 3 stations in those days, ABC, NBC, and CBS. And Lifestyles of the Rich and Famous came on, and they said, we're going to count down the top paying professions, the top 10 paying professions. I thought, this will be interesting since I'm looking for direction in life. And number 1 was investment banker. And they said, you have to be very hardworking and you have to be extremely analytical, but it's actually a very lucrative profession. So I decided then and there that I was going to be an investment banker, but I didn't know what that was. So I went to the Yellow Pages back when there were phone books, and I went to the Yellow Pages and looked up investment bankers, thinking that I would find some local investment banking outfit in Southern California and I would get a job there. But as it turned out, there aren't any listings in the Yellow Pages for investment bankers, but there were listings for investment management. And so I figured it's got to be sort of the same thing. And so I ended up sending a couple dozen resumes with a very aggressive cover letter to the firms that had a bold-faced ad in the Yellow Pages. And I actually got three replies. Most of them didn't bother replying to me. And one of them was for a job interview, and I ended up going to that interview, and they asked me, what do you think? You've got a very interesting mathematical background. What do you think you could apply that best to, equities or fixed income? And I said, I don't know what those things are. And the guy almost fell off his chair that I was interviewing with, and he said, well, equities, that's stocks. Fixed income, that's bonds. And I didn't know what bonds were. So I said, I want to do stocks. And it turned out that they needed more help in the bond department for a quantitative person than in their equity division. So I started in this tiny little bond department, and it was really little. It was like 4 people in the entire bond department. And it was really just a necessary evil. In those days, we're talking about the early 80s, there were a lot of what we call balanced accounts. So pension plans would give their money to a manager, and they would do stocks and bonds and allocate between the two. And it was really a stock operation. The bonds were a necessary evil. We just bought treasury bonds mostly, a few corporate bonds, all very, very low risk and mundane stuff. And it just turned out that my background was kind of perfect for understanding the kind of bond math stuff. And within a week, I'd say I knew more than the people that were running the department, because they were just placeholders, really. Right. And I thought I was kind of doomed because it was clear to me that they didn't know what they were doing. But as I learned later in life, that's actually opportunity. That's what opportunity looks like.
Sorry for interrupting your video, but I have a very important message to share. At Real Vision, we pride ourselves on providing the very best in-depth expert analysis available to help you understand the complex world of finance, business, and the global economy. So if you like what you see on the Real Vision YouTube channel, that's just the tip of the iceberg. You should come to realvision.com and see how we're not leaving any stone unturned. From publishing more in-depth videos, live discussions, written reports, and our latest feature, The Exchange, where you get a chance to engage with experts, fellow subscribers, and learn from everyone's experience, which can't be wrapped in a video. It's an experience which you live and learn from. So if you go to the link in the description or go to realvision.com, it costs you just $1 to get a month's access to this incredible content. I don't think it's something you could afford to be without.
Placeholders, really.
Right.
And I thought I was kind of doomed because it was clear to me that they didn't know what they were doing. But as I learned later in life, that's actually opportunity. That's what opportunity looks like. When you're working for somebody that's really in over their head, if you can, help them out and lend a hand, you actually become very valuable. And so I started running money. And within 6 months, I was given the Chrysler pension plan portfolio to run.
Wow.
Which is a few $100 million, because it was a very sensitive account and everyone was afraid to screw it up. And so they ended up giving it to me with 6 months of experience. As it turned out, I was really good at it. So I ended up just doing more and more stuff and learned a lot about mortgage-backed securities, which were a very rapidly growing area in the late 80s. And it turned out that I had a knack for it and started a mortgage-backed securities-related investment program. And about 5 years later, I was in charge of the entire fixed income situation, right from junk bonds through treasuries, mortgage-backed securities, and all that stuff. And those were good times because interest rates were relatively high. The markets were really inefficient. I mean, compared to where you are today, it was so inefficient. There were simple securities like Ginnie Mae's that would trade with a 1 point sort of discrepancy in the market, which was a big deal in bonds. So someone would be offering a bond at 99 and you were able to buy it from somebody else at 98. You could actually just flip it from one broker to another, actually. You couldn't do anything like that today with all of our AI and electronic trading and all that. But that's what happened. And so I ended up, as luck would have it, I had the best track record for many, many years in the entire industry. And so after a while, that attracted a pretty decent client base. But what really set off my career into like a retro rocket was calling the credit crisis. I was very vocal in 2006 about the stock market was going to crash and the subprime market. The quote that was carried on 5 continents that I gave at a major conference in June of 2007, when people weren't fully aware of how bad things were about to become. I said, subprime is a total unmitigated disaster and it's going to get worse. And that got picked up. And within weeks, really, Countrywide, which was one of the largest originators of mortgages in subprime, was bankrupt. And of course, Citigroup was essentially needed a government bailout, and Bear Stearns went under, and we all know, it's all in the history books. But because I was in the mortgage market primarily and completely sidestepped the entire debacle, it left me in a position when things got really washed out in 08 and into 09 to deploy massive amounts of capital, tens of billions of dollars, into the things that had been thought to be safe and then started to trade at 40 cents on the dollar because there was such a huge supply-demand imbalance and such ugly fundamentals. I was able to deploy all that. And so I had this awesome year in 2009 as well, riding the bounce back. And so at that point, I think people realized that there might be something going on here that's worth investing in. And that's when I really started to get a tremendous amount of exposure. And then we started Double Line, and we had the best results right out of the box in the industry for a few years. And so it was easy for the clientele to just say, this Double Line thing is fine with me. And that's how it ended up happening.
So obviously, as you go through your journey, you're going to make mistakes. What was the first mistake that made you realize, okay, there's a lot of things I need to learn still? So when you're going way back, talk about some of these mistakes, because that's where all the learning lies, right? Being right.
Yeah.
You learn less from actually being wrong.
Yeah. It's kind of funny. The very first big trade I did was actually the most successful trade of my career. I actually sold 30-year treasury bonds at a yield of 7%, which was thought to be really, really low. And that was in April of 1986. And I actually sold at the top tick. And the market just started tanking after that. And then it started to rally back. And the big mistake I made was I ended up being long the market right before it started to drop again. And I remember feeling that I was trapped in this trade. I remember thinking that I just kind of knew that the market was going to drop, gap down like every day, because it was doing that day after day after day. And I was just trapped in this position, and I was losing tons of money. And I just remember, actually, I was in a rock band at the time. It was actually my first career was in rock and roll. And I wrote a song that was called Wishin', Hopin' and Prayin', because that was exactly what I realized I was doing in that trade. I was just wishing, hoping, and praying that the market would reverse to the upside, even though in my bones, I kind of knew that wasn't going to happen. And I started to realize that the phrase that a guy actually told me when I explained my situation to him, he said, your first loss is your best loss. And that's really good advice in investing markets. You're in the wrong trade. Maybe your premise was wrong. Maybe new information came out that caused a reversal. You just got to get out, even though you're taking a loss. And so the key thing that you learn from something like that is you just have to act. You can't just be frozen in a position, and you have to acknowledge that your first loss is your best loss and to get out. And that was a big deal. The second biggest mistake I made was actually something I did not do rather than something that I did do. And that was in 2003, or 2002 rather, in the aftermath of Enron and the scandals in the corporate bond market. There was an incredibly high degree of flight to quality, and the junk bond market was trashed. And in all the accounts that would traditionally run corporate bonds, I went to my maximum junk bond position, but for some unknown reason, thinking that in my core strategy where I never took corporate credit risk, for some reason I didn't want to get my hands dirty or something with the corporate bonds, and I didn't buy any, even though I went to my maximum in the more diversified accounts where corporate bonds were a typical, if not consistent investment. And and because of that, I missed the entire massive rally from October of 2002 till October of 2003. The return on treasury bonds was like zero, but the return on junk bonds was 30%.
Oh,
and I missed the entire thing because in the one strategy. And so I told myself, I'm never going to be so foolish and narrow-minded again. The next time there's a big washout in credit, I'm going to go into junky bonds, even in this low-risk flagship strategy. What ended up happening, though, was that the crash in credit was epicentered in mortgage-backed securities. And so I ended up going massively long junky stuff in 2009, early in the year, but it wasn't in corporate bonds. It was in the things that were actually the cheapest, which were mortgages. So it's kind of ironic. I still have never done in that traditional flagship strategy, which I've been running now for over 35 years. I've never owned a corporate bond, even till this day. When the corporate bond market crashes, which it would have without the Fed, the corporate bond market was crashing in March into April. I was ready to pull the trigger, but the Fed, pulled the rug out from under the opportunity with their illegal bond buying activity in the corporate bond market, which, as you know, is in direct violation of the Federal Reserve Act of 1913. They're not allowed to do it, but this is just a different situation. So almost anything is possible, as we've learned over the past 12 to 15 years out of the central banking community.
How did you navigate the really difficult bond market of 94? That was a brutal period for bonds, right?
It was a big interest rate rise in a compressed time frame. And the biggest problem of 1994 was that it came after a big interest rate decline that brought short-term rates down to about 3%, which was thought to be absurdly low at the time. And because of the low interest rates, the mortgage market, which was the bulk of my investment activity, was refinancing in a very rapid fashion. In fact, it set records at the time. Those records were broken in 2003, but it was really high refinancing. And that created a short-term maturity concept in the mortgage-backed securities market. If half the mortgages refinance in 1 year, the securities that are backed by those mortgages are definitionally very short-term assets with low durations. And the yield curve was very steep in those days. The short rates were at 3%, long rates were more at 6 or 7% or something like that. And so when the rates started to go up, the refinancing went away because obviously the opportunity to refinance wasn't as attractive. And suddenly the mortgage-backed securities market went from an interest rate maturity of about 2 years to one of about 10 years. So not only did you have to endure a 300 basis point interest rate rise over about a 9-month time period, but you also had the unfortunate experience in the Ginnie Mae type of market of extending and rolling up the yield curve. So the losses were pretty extreme. And then you had margin call problems. You had Orange County that didn't own mortgage-backed securities. There's an urban legend that that's what they ran into trouble with, but it's not true. It was just Fannie Mae debentures. But they ended up rolling up the yield curve on them too. And they ended up liquidating those assets, unfortunately, causing the low of the bond market of 1994. I had the worst year ever in my most aggressive strategy in 1994. I was down 23%. In 1994. In my more traditional strategies, I was down a small amount, but in my most aggressive strategy, I was down 23%. But amazingly, in the first half of 1995, the market reversed pretty strongly. And by the middle of 1995, by June 30th of 1995, the entire 23% loss had been erased. And I was actually up 53% in the first half of 1995 because the market was trashed on supply demand problems. We were talking about government guaranteed mortgages. Some of them were trading at prices that anybody that didn't experience 1994, anybody that's only been in the market for 20 years, they probably wouldn't believe how cheap these securities were. I mean, the Treasury bond market was yielding something like 7% or something, and there were securities that yielded, to the worst possible case, 16%. That you could buy in the mortgage-backed securities market, but there was just an overwhelming problem of selling, and that prepared me tremendously for the 2007-2008 period, because it made me realize how much prices can drop when you have a supply-demand imbalance of that magnitude. Valuation makes absolutely zero difference when you're in a true brutal bear market. You just go to prices that you just can't believe, and so when the market started to crack in 2007, one of my guys, he's from Latvia, and I used to call him a crazy Russian billionaire. He wasn't Russian really, he was Latvian. He certainly wasn't a billionaire, but he was certainly a little bit crazy. He still works for me. He's now actually the head of my agency, mortgage-backed securities division. But the prices of a lot of these adjustable rate mortgages had never gone below 100. They were perceived to be credit risk-free, AAA rated. They were floating rate, so they had no interest rate risk to speak of. And they had never traded below 100. I'm talking about the AAA rated prime mortgage-backed securities. I'm not talking about subprime garbage. I'm talking about really good underwriting. They had never traded below 100. And then there was the margin calls started to come in the late summer of 2007. And one of the greatest originators was Thornburg, a mortgage REIT. They're a really good originator, and they got caught in a liquidity problem, and they got margin called one Friday afternoon. And there were hundreds of millions of dollars, these prime mortgages that were being margin called away. And I decided, well, they were traded below 100 before. They were being talked at 97 cents on the dollar, which was the lowest price anybody had ever seen. And I put a throwaway bid of 93 on a $300 million package of these mortgage-backed securities, and I got hit. And my crazy Russian billionaire guy, he says, "This is way too cheap, way too cheap. This is the cheapest bond I have ever seen." And him saying that triggered this crack of doom feeling all the way down my spine that reminded me of 1994 in the Ginnie Mae market when the prices got so absurdly low. And I said, "You're going to write that on the ticket, Vitaly. Write it on the ticket. This is the cheapest thing I have ever seen, because mark my words, the prices are going to go way, way, way lower." And I said, "We're putting a moratorium. We're not buying anymore until the yields," and the yield at the time was like 8%. So the bond, it was like at 93 cents on the dollar, and with a 6.5 coupon or whatever, it was an 8% yield. I said, "Mark my words, these securities are going to go to yields in the teens." But I was wrong. They went to yields of 40% to no losses, actually. But it was that experience from 1994 of how low the Ginnie Mae prices got that made me realize when things really go bad, they go way worse than anybody thinks. And you get to this level where they're just completely fire sailed. And we managed to navigate the global financial crisis probably better than anybody else in the fixed income business because of the institutional memory and experience. So one of the things that makes a good investor is actually, you talked about mistakes, you learn from mistakes. Absolutely, having a memory, an emotional memory, and an institutional memory that you don't forget your mistakes is really valuable. My uncle invented the Xerox copy machine, and he was one of the greatest inventors of the 20th century. He's in the Hall of Fame. There's such a thing as the Inventors Hall of Fame. And he was interviewed, and he said, a successful inventor is a accident-prone scientist that pays attention. And that's kind of the same thing in the investment business. You make mistakes, you're going to make them. There's probably 2,000 mistakes you can make. I've probably made all 2,000 of them twice, but thankfully I rarely make one a third time. So you have to have that memory, and a lot of it is actually kind of emotional memory, what the market feels like. Like this year, I was very bearish on the stock market in February. And I have a fund that I run that's mostly my own money. And I was very short. I was actually 300% short the US stock market. And I covered those shorts on March 23rd. I didn't go long. I wish I had, but I covered the shorts. It was because the market felt total panic. It was that day when Bill Ackman went on TV and was talking extremely negatively, even though apparently he was buying stocks at the time. But he was talking very doom and gloomy, and it became a big topic for that morning. And I realized that was kind of the environment where you really have the washout. So again, it's that kind of emotional memory that has served me very, very well, and not just accepting your mistakes and learning from them.
So what's your, I'm going to talk about your personal investing style, and then as a business, obviously, because you run a lot of managers and stuff, but your personal investing style, what is that like now? How do you use charts? Are you very mathematical prices based? Are you a feelings guy? How do you construct from an idea through to the execution? Because that's fascinating. People don't get to hear about how you do that.
Well, I'm a big believer in cycles and charts and retracements and support and resistance and all that type of stuff. And I spend a lot of time analyzing offsides positioning. So sentiment, call buying, which is absurdly high, has been for months now, thanks to retail and these slices and all these other retail products. So I look a lot at sentiment and where things are. For example, I'm very, very negative long-term on the US dollar. I've been a dollar bear structurally since January of 2017, where I had been positive on the dollar for about 6-7 years. And then I turned negative in January of 2017. But I'm actually long the dollar now, even though I don't believe in it at all as a good investment for the next 5 years. But the positioning against the dollar got pretty extreme.
Crazy,
about a month ago. And the level, there was a double bottom, back on the Dixie index at about 92, down from 103 in January of 2017. And it just seemed to me that there was no momentum on the downside. There was just a lot of negative positioning. And so for a trade, we went long the dollar. We haven't made a lot of money on it, but we're in the black.
So you don't mind trading against your macro view from time to time when you see a specific opportunity coming.
That's right. I will not go mega long the dollar thanks to my macro view, but I am positioned moderately long the dollar. So my macro view on the dollar, it's actually that is my highest conviction macro idea, is that the dollar is going down. And I know I'm not alone in that view, although I've been of that mind for a while. It has a lot to do with this absurd deficit problem that we have gone into on steroids here in 2020. The correlation between the dollar going down and the twin deficit going up is extraordinarily tight. And the deficit is obviously exploding. Forget about the trade deficit. It doesn't matter. It's trivial compared to the budget deficit. And the budget deficit is going to just get worse and worse and worse. And so the dollar seems almost assuredly to be going lower. In fact, another thing that causes the dollar to go low is, the Fed has really pivoted a lot over the past couple of years. And so you don't have anything resembling a strong dollar policy thanks to interest rates. And so I think the Fed has been quite clear that they want inflation to run significantly higher than 2%, at least for a while. And they have no problem with that concept. In fact, they embrace it. And that's another reason to be bearish on the dollar. So it hasn't been a money-making trade in any significant way, but I think that's the big trade for the years ahead.
Do you mainly now run the whole portfolio as a pure macro view? Because obviously originally you were mortgage-backed securities, you were much more in the weeds, you knew inside and out every part. You now seem more macro in your view. You're multi-asset now, is that right?
Yeah, I've really changed my role in investing very substantially over the past 15 years, most of it in the last 10 years. When we started Double Line 11 years ago, I was doing a lot of trading, a lot of micro stuff, a lot of security selection, a lot of arguing about a quarter point on a trade and all that stuff. But as the firm grew very rapidly, my time was not well spent doing those things because I've had a team working for me that I've trained for many, many years. I mean, many of my people that work for me have worked for me for 20 years. And they will come to the same conclusion on the micro stuff because I trained them. And we've worked together very closely for a long time. So let them argue about the quarter of a point and let them decide whether you want Ginnie Mae X or Ginnie Mae Y or corporate bond, A or corporate bond B. What I am trying to do is really get us in in the tailwinds of the macro stuff. And I've gotten a big team built around that. We have a very extensive meeting. We just had it this morning. It lasts a couple hours, going through 250 pages of charts. It's very disciplined, but we evolve it, of course, as the world changes. But we go through and we basically rank every asset class in the world with a fair amount of granularity, actually. And we decide that this is our positioning for, really, we're thinking about an 18-month sort of a time window, although we will, as the big centerpiece of what we're doing. But then, we'll adjust it for a multi-week sort of counter trade or whatever, not in a major way, but just try to add a little bit more value. And I have I spend a great deal of time on trying to understand, the macro stuff and how it's changing. And I enjoy it, and I've developed a style that I think has been quite value added. So I enjoy it, and I'm good at it. So and everybody kind of falls in behind because it's funny when a lot of people they kind of. It takes them a while working on the team to understand that we're pretty much get the macro stuff right about 70% of the time, which is a very high batting average. I mean, if you can get it right 53% of the time, you're going to be successful. But most people get it right about 48% of the time, and that's the problem. But for some reason, I seem to have a good vision on that stuff and get it right about 70% of the time, which means I'm wrong 30% of the time, which is, when you've been in the business 35 years plus, 30% of the time, I've been wrong for a decade, right? So if anybody wants to hate on me, that's fine. I hope you've got a long time period if you want a list of things that I've gotten wrong. So,
Jeffrey, the other interesting thing about that is I have a feeling that one of the reasons why the 70% number, which is high, as you say, is because your time horizon is different to most participants, right? So most hedge funds are monthly mark to market, but you're trading with longer term views. You can accept different types of drawdowns in individual positions. You can construct your portfolio differently. So totally it's time arbitrage, because macro, as you know, I mean, we get one bloody piece of economic data a month. I mean, nothing changes for 6 months. Yeah. So, it does take time to play out. Do you think that's one of the secrets?
Absolutely. In fact, one of the very first things that I did in the investment business, I was working when I started in the bond department. There was a guy who needed some quant support. And he gave me a task of just doing a historical study on what time horizon of investment would be most optimal. And we started out with a study that we assumed that you had perfect foresight with a 5-year horizon. So we just used historical data on every asset class and said, let's just say that on day one, you have perfect foresight and you invest in the asset class that ends up being the number one returner for the next 5 years. And you can do that because you're just using historical data. So you're just analyzing return series. And what we concluded is that even if you had perfect foresight with a 5-year horizon, you would probably go out of business, because so many of the actual data series displayed the characteristic that even though you knew with metaphysical certitude that you were in the right sector for the full 5 years, so often it was bad for the first 2. And the return was very often backloaded in those 5-year periods. And we came to the conclusion that your clients would fire you if you were that bad for 2 years and refused to change.
Just when your P&L was about to take off, you've got fired.
Right. It's just like that value investor. Was it Julian Robertson that closed down in 2000, a value manager right before value really did well. So we came to the conclusion that 5 years is too long. It might be fine for your personal money because you don't have anybody badgering you about it. But when you have clients that want quarterly and monthly reporting, they're going to complain, as they always do, even if you have a bad quarter, let alone 2 years in a row. And so I came to the conclusion that 5 years was too long, but I also perceived that what most people say they do, which they're lying actually, they say that they're thinking about, they're analyzing markets continuously all the time, which of course is a lie. When they're asleep, they're not doing it. When they're eating lunch, they're not doing it. But most people, they do have like a weekly meeting. And some people make changes pretty frequently. You talk about hedge funds have a short horizon. I just think that the longer your horizon is, the higher the probability of your success. If I wanted to invest for my great-great-great-grandchildren, I'm positive that certain real estate investments and certain resource investments would be obvious winners. But, who cares about your great-great-great-grandchildren? So you have to balance the higher probability of a long horizon, with the tolerance of your investors, your impatience of your investors. And I came to the conclusion that 18 months was the best horizon. It's long enough that you bring your probability, in my case, up to about 70%, but it's short enough that you don't have the 5-year problem. And I've succeeded in this business by having about an 18-month horizon. And sometimes it ends up being 2 years, and sometimes it ends up happening in a year. But I found that to be the real sweet spot, and it served me very well.
Yeah, I was running a macro hedge fund for GLG back in London back in the day, and I eventually left the business for the reason that I just thought the time horizons were mismatched.
Yeah.
And since then, I've written a research service, Global Macro Investor, of which I've gone at exactly the same time horizon, and I haven't quite hit 70%, but not far off from exactly the same structures. Nobody's doing it. The time arbitrage is good. If I went to shorter term trading, I'm just not that good.
I'm sure my results would be substantially worse. I think my hit ratio would go down to 55% if I was really trying to do month by month. And a lot of people burn out in hedge funds. That's a very common thing because they're so short-term oriented. I mean, I've talked to many hedge fund managers who say that they wake up several times in the night and have to grab for their phone because they're panicking about, the opening in Singapore or something. And, that's no way to live. So I'm not surprised that people that use that very short-term horizon don't have staying power.
How do you think about, before we go on to your views going forwards, because now we've framed your time horizon and stuff like that, which is always really important, because if you don't listen to somebody's time horizon, you don't understand what they're saying. And so few people do. Talk to me a little bit about risk management. So how do you think about sizing a trade? Because, you talked about the 300% trades that you've had. Those, sometimes you get these opportunities, but they're rare. How do you think about trade sizing overall?
Typically, it kind of depends on the asset class. Like if I'm running a corporate bond portfolio, if it's risky stuff, I really don't want things to be more than about 1% under normal conditions, any particular name or something like that. In the mortgage market, when I used to invest in some really risky refinancing-oriented securities, which can have huge price changes, I wouldn't have a single position that was more than 0.5%. Because there's a lot of idiosyncratic things that can happen. But I'm completely comfortable when you get to those rare moments where I'm pretty comfortable going sort of all in. But you have to be in those rare moments. I mean, it only happens probably once every dozen years or so. And it takes all the patience in the world to wait for the prices to just drop. But once you get to that level where you can almost analytically prove that you're going to get more money back, we're talking about bonds here particularly, that you might not get all your money back if it's a corporate bond situation or a default-oriented commercial mortgage-backed security, but you get to points where it's virtually impossible to not get more money back than where the market is actually willing to sell you these securities. And at that point, I'm pretty willing to go all in. Now, what I mean all in, I'll actually raise funds to do one trade. I did that in 1994. I did that in 2008, 2009, and I'm preparing to do it again. But the market opportunity isn't there yet. It's not. The Fed has really. It was coming, but the Fed screwed it up with their bond support purchases. But I would start a fund to do basically one, and it's almost a beta trade. So I have two different styles. There's the normal course of business where everything's an alpha trade, and that's where we are right now. Clearly, I mean, the opportunities, particularly in the fixed income market, are pretty paltry. And so everything's an alpha trade. There's no beta that's worth anything right now. So you have to find parts of the capital structure that are particularly cliffy and all that sort of stuff. And so right now everything's an alpha trade, but you do alpha trades waiting for the big beta trade. And when the beta trade comes, I don't want risk management. Risk management is when you're in the alpha trades. You need risk management right now. When the market falls apart, you don't want risk management. You actually want to just put the pedal to the metal.
Because you want to take as much risk as you can when you've
got to. Yeah, because it only happens. I mean, it only happens 5 times in a lifetime.
Yeah, entire career. You only get a few of those.
Right, and so you have to really push it. Like I said earlier, my biggest mistake was I didn't push it the way I should have across the board in the corporate bond market in 2002, and I sort of vowed I would never miss that again. So, but you have to play defense, waiting for those things to come, and that means a lot of diversification, small position sizings, particularly when you're in a market that is. I would say is priced for good outcomes, assuming that nothing bad will ever happen again. And we were there in February of this year.
Yeah,
we were there, but and I think we're going to get there again. But this whole situation that we're in right now is wickedly unstable in my view.
Yeah, let's talk about this a little bit. I mean, look, I'm 30 years in this, and I'm a bond market guy because that's been the greatest source of risk-adjusted returns of almost anything. And here we are with a bond market that's got like zero vol, and the credit
almost
market
literally zero, right?
Zero vol as well, because the Fed have stopped the credit market. So yes, I can see the kind of more credity related equities are selling off or moving around a bit. It's a bloody hard market for macro right now. The dollar's not done anything much, as you say.
Yep.
So we're kind of stuck. What are you thinking?
Well, we were just having this discussion this week in one of my strategy meetings where some of the people were lamenting the state of affairs. And I said, you just have to take reality for what it is. I mean, if you were only a treasury market investor, right now, the situation is truly hopeless. Hopeless. I mean, the yield is 50 basis points, and the vol, as you correctly stated, is 0. So you have virtually zero income, and there's no volatility to trade that you could actually, make something happen through price change. It's literally hopeless. And so you just, in environments like this, you actually just have to not try very hard and just accept the fact that you're not going to be posting big numbers, because any attempt to post a big number is probably a very long shot in terms of potential success.
Yeah, I mean, you can wait for the breakout in the end, because if you push a position in a market like this, as you say, you can lose money. So then you trade options and you just bleed time decay. It's just not that kind of market.
Yeah, I have been way less active in the past, I would say 3 months, than pretty much any time in my career. I was quite active, of course, in March and April, where you were just trying to stay alive. But in the last few months, there's just nothing going on. But you always, low volatility leads to high volatility. There's a reason why Death Valley is right next to Mount Whitney. Death Valley is the lowest spot in the lower 48 states, and Mount Whitney's the highest spot. There's a reason why they're right next to each other. That dirt's got to go somewhere, and that's what happens. Vol never stays low, and so you simply have to pay attention and wait for the opportunities, because the vol will go up. I mean, interest rates will not stay at 67 basis points on the 10-year forever.
No, my view is always that suppressed volatility leads to hypervolatility.
Absolutely. It's actually Gundlach's law of investment physics. I say the frequency of trouble times the magnitude of trouble equals a constant. So if the worst thing you can try to do is invest in one of these hedge funds that claims they've got everything, all the risks are ironed out flat, and they find a way to make 75 basis points every single month. And it's 75 basis points every single month. And I've seen a few of these come and go, and they can do it for a couple, 3 years. And then comes the bankruptcy filing, because when the vol comes, they lose 100%. So an attempt to make an earnings stream, a return stream that's absolutely constant at some level above the risk-free rate is doomed to a bankruptcy failure, because usually those types of strategies also employ many turns of leverage, and that's ultimately their downfall. Remember long-term capital management, which should have been called short-term capital management because they weren't even in business for 5 years. That was a bad construct right there.
But I remember
attempts never work.
I was in running a reasonably large hedge fund in London back in the early 2000s, and our competitor was this other fund that was well known, and it was doing 1.5% a month, 2% a month, consistently, but consistently. And our P&L was moving around, and we were reasonably well performing, and it was moving around. I'm like, how is this possible? What are they doing? So it's 2%, 2%, 2%. And all the investors are going, well, you guys are idiots. These guys know what they're doing. It's just you guys are fools. 2%, 2%, 2%, down 47.
Right. Well, that's the way it works.
Selling options.
One of the funniest things is a lot of large investment pools employ consulting firms to help them analyze risk-adjusted returns and the like. And unfortunately, they don't really quite understand how things work. And they use a lot of CFA manual types of techniques. And I saw one of the most entertaining speeches ever. I was speaking at a client seminar conference, and there was this fellow that got up there. He was really entertaining. And he went through some risk-adjusted return analysis, and he got everybody all hyped up and convinced that there was this. He was just using actual return streams as an example. And he got everybody to agree that there's one investment they would absolutely positively do. And then he revealed that it was the historical record of Bernie Madoff. So you got to be careful on these things that look like they somehow have solved the entire problem of eliminating volatility while keeping returns high. Because I just wouldn't even want to go there. I wouldn't give a dime to somebody that has one of these 2% a month sort of attempts, because you're going to lose all your money within 5 years.
So looking forward to acknowledging that the markets are pretty frustrating right now, what do you think the good opportunities are over the 18-month time horizon? You've talked about the dollar a bit.
I think 18 months is enough for the dollar to fall.
Yeah.
And that means, probably the most frustrating allocation that many investors and pools have made that has not paid off is recognition that the returns of the United States stock market, let's just say the S&P 500, have just been so incredibly dominant versus the rest of the world. And that those returns are really, for the last couple of years, only in the S&P 6. The S&P 494 have no return at all over that time period. And so I've got this kind of strange advice for people. I say, if you want to own US stocks, you should own those 6, knowing that you're going to take a bloodbath if you overstay your welcome. But it is a 100% momentum-based market. the most dangerous type of market in the world. I mean, I turned negative on the NASDAQ September 30th of 1999. I was really negative. Of course, in the fourth quarter of 1999, it went up 80%. But 1 year later, it was down 50% from the September 30th level. And I feel like we're in that type of an environment. Yeah. So if you're going to own US stocks, which I don't recommend, but if you want to own them, I think the only way to go is those 6. And you just got to have your finger on that the exit button pretty close by. But I think that's your only chance of making money. And yet I don't want anything to do with it, because I feel like this is the NASDAQ.
Do you buy into the theory that people are thinking of these tech companies like the new zero coupon bonds? You know, that these have infinite cash flow, and with zero interest rates, these just go to the moon. There's no valuation. I mean, I can tell by the smirk on your face you don't believe
they've already gone to the moon. I mean, it's so strange how faddish the market has become. The one that just kind of blows my mind is actually not a tech company. It's actually a restaurant company. It's Chipotle. And I just can't understand why the stock has tripled over the last 6 months. It just baffles me. And yet people say, well, they're thriving on their delivery. Okay, but isn't the PE like 150 or something? I mean, that's a lot of tacos. So, but yet the stock is invincible. I was actually short that stock in February, and as good luck would have it, I covered it on the low because it's tripled since then. So I would have gotten hammered. But I just think we're in the late. My thinking is we're in the late stage, very late stage of this momentum market. It can always continue longer than you think possible. But I do think that within 18 months, it's going to crack pretty hard. And so I think that you want to be avoiding it for the time being. And I think when the next big meltdown happens, I think the US is going to be the worst performing market, actually. And they'll have a lot to do with the dollar weakening. And so I know a lot of people have diversified out of the US on valuation reasons and on just relative performance differentials, which are really kind of mind-blowing, how well the US has done versus, Japan hasn't done anything for forever. Europe's not doing anything. But I do think that you're going to be not well served in dollar-based investments, which would include the U.S. And this would be, you don't have to do it today necessarily because it really needs a rollover to start getting going. But I do think that diversifying away makes a lot of sense. So there's something that was very popular, and it gained a lot of money, a lot of AUM. It was called the permanent portfolio. And it was a very simple concept. I think it had 4 things, equal weighted. I think it was stocks, high quality bonds, cash, and gold. And I think they were 1/4 each. And it got very successful because there was a window there in the aftermath of the global financial crisis that did really well, that mix of assets. And then it fell on hard times when stocks really got going and the AUM in that particular permanent portfolio mutual fund collapsed. But I think that's a good investment right now. I think we have such a potential tail risk of outcomes, such a disperse potential outcomes, that you really need to have this kind of barbelled asset allocation concept. So I actually think owning 25% gold isn't crazy right now, nor do I think owning 25% cash isn't crazy. They're kind of the opposites. And I also don't think 25% stocks is crazy, because one thing about a potential inflationary environment is stocks can add a zero to their prices. You might not gain in real purchasing power, but you can keep going with a nominal value that has some sort of inflation protection. And the high quality bonds, maybe you're supposed to just have two doses of cash instead of that, because the high quality bonds, the yield is not much different than zero.
There is a possibility. I'm more of a deflationary kind of guy, and even in your dollar scenario, right? It sounds like the dollar goes up, blah blah blah. That's deflationary for a period of time. So the bond part of the portfolio works. Maybe rates go negative in the US. Maybe they go to zero, properly zero, 30 years. And then after that, we get inflation. But that whole portfolio kind of makes sense,
Yeah, I agree with you on that. I am ultimately an inflation fearing person, but in the short term, I do not think there's any inflation. I think what's happened this year is pretty clearly deflationary. And particularly, I think white collar wage deflation is going to be pretty intense. I mean, one thing about work from home is it gives you a different prism through which to analyze your business and the way businesses operate. And I'm pretty sure just about every business owner and CEO has been made aware of ways of working more efficiently remotely, or maybe they can cost cut by moving some operations to other places. Like my IT department has said to me, there's really no reason for us ever to go back in the office. There's no reason because they just live on the 16th floor on our building, off in a corner. You never see them. They're just behind a closed door typing away. They can so easily do that at home. Why do we need that office space? That's clearly deflationary. What about the traveling salesman that can't travel right now? I mean, I think most businesses are probably thinking, do I really need this many traveling salesmen? No. So there's going to be a lot of deflation in the wages of traveling salesmen, and a lot of other middle managers, I think, are going to learn that people have figured out that all they're doing is watching people work that report to them and not really doing any work. And maybe you don't need so much middle management. I think all of this is deflationary. What if somebody moves, they're tired of all the needles on the sidewalk in San Francisco, and they decide they want to go to Boise? Well, you don't have to pay them as much, right? I mean, the cost of living is lower. That's deflationary. And if somebody who felt at risk of losing their job in March and April, they're probably still fearful of an event of job insecurity. I think that they're going to take a pay cut rather than a pink slip. So I do think that there's a lot of deflationary things. And until, weirdly, as Lacey Hunt points out so academically correctly, one weird thing about the deficit is it really isn't inflationary. It's not inflationary until you start actually declaring the liabilities of the Federal Reserve to be legal tender and actually giving money to people, which we're starting to do. That's why I'm ultimately an inflationist. When I used to give speeches, when there used to be gatherings of people, I used to routinely say, I know how to get inflation by 5 o'clock this afternoon, literally. We have an announcement from the Treasury Department that every bank account in America is going to have a $1 billion deposit at 4:59 this afternoon. That will cause inflation. Because if we don't have inflation, the lines at the Ferrari dealers would be something to behold if you gave everybody $1 billion at 4:59 this afternoon. So you can do it. There just has to be the true desire, the true commitment to doing it. And obviously, we've been ramping up this procedure ever since the global financial crisis of giving money to people. Actually, it's kind of comical how people talk about modern monetary theory or universal basic income as some wacky idea. We've been doing it since the 60s. I mean, not to the whole population, but what do you think welfare is? It's universal basic income, but it's not universal. It's just for a certain subset of the population. And it hasn't exactly solved the problems. In fact, in my view, it's made them much worse. But, you can get inflation, but you have to really, really want it. And I think it takes more pain of disinflation.
I want to talk about the pain. One of my thesis is we've got a massive insolvency about to happen. Because the market's not pricing this yet properly, but it feels that, look, if you've taken, so let's say where's GDP year on year right now? Probably down 5% year on year, right? So this is still the biggest recession of our life.
It's -9 in the United States year over year, June 30 to June 30, 2020.
Okay, so look, this is still the biggest recession since the 1930s, and we're just coming off the bottom of the massive quarter. But even if I look at the real-time economic data, maybe it's down 7 or 6 or whatever the number is, right? It's still huge.
Yeah.
And there's no cash flow, as you pointed out, all these deflationary things, every restaurant, small business is closed, everything.
Well, I don't think people fully understand how many business closures there's going to be in the next few months. because I don't travel out of my property here very often because we're working from home, and I'm not going to go to a grocery store or something. I've got people for that. And so, I venture out every now and then, and I had to go to the bank. And I was shocked at the empty storefronts, how many empty storefronts there have started to develop in the last, say, 6 weeks. I mean, businesses that have been in place forever, they're now just for lease. And there's going to be a lot more of that. And I think it's going to really accelerate. We were talking this morning, what about the movie theater industry? I mean, what's going to happen there? How long can they hang on? And I think there's going to be real problems in the wintertime here.
And even more concerningly, look, it's concerning for the individuals, all of these small businesses. That's the bulk of American capitalism, is these small businesses. But when you look at this massive group of triple B rated companies, right? On the edge of a cliff, and the Fed stopped it. They stopped what had to be the market clearing event, which is all this triple B was going to go to junk.
Well, the triple B bond market in 2006 or 7 or so was the same size as the junk bond market. Today, it's 300% the size of the junk bond market. So if 1/3 of the triple Bs get downgraded, the junk bond market will double in size.
Or halve in price.
Something like that. Yeah. I mean, that's obviously some combination of the two, but that's almost certain to happen, I think.
But
and
the
you're
Fed
right.
is stopping it happening.
The Fed stopped it by providing liquidity. But as so many people have correctly pointed out, there's a big difference between short-term liquidity and long-term solvency.
Yeah, but the issue is
the Fed can't stop the insolvency.
But they are buying corporate bonds, right? So they're buying bloody Microsoft bonds and G bonds and everything else in this in this BlackRock fund. I'm like,
yeah, they haven't bought very many. They didn't really need to. It was just doing any of it that made people decide that the prices were supported and that they had something of a put to the Fed. It hadn't ever occurred in the junk bond market before, and it's not supposed to happen. But they're that close to just buying equities. I mean, they're one slice of the capital stack away from doing the Bank of Japan and just buying the equities. I don't know if they're going to do it or not, but at this point, unfortunately, because they're in violation of the Federal Reserve Act of 1913 right now, almost anything can happen. Because why stop there? You've taken the guardrails off of the operations that are deemed legitimate. So we'll see what happens. But the downgrades have already started to happen. It's really interesting to look at charts about lending standards, surveys of bank loan officers and the like, and just how much tighter standards are.
Crazy.
The junk bond market should probably be right now at a 15% default rate year to date, but it's not. And the downgrades almost certainly have to come. And clearly, there's just a lot of overinvestment in the corporate bond market. Thanks to the way it behaved this year, I think there are quite a few investors, unsophisticated investors, that believe that corporate bonds have no risk.
So one of the things I've been looking at is, I looked at this too, and I'm like, it's so frustrating because, as you said, there should have been a good opportunity here. You could sort out the wheat from the chaff. So what I did is I constructed a basket of triple B rated equities. So I just took the largest component of each part of the triple B market by sector, did an equity portfolio. That's interesting because the equities are moving. I'm kind of thinking, I'm looking at the European bank stocks as well, right? And I've been following those for a long time. And I think the equity goes to zero, but the bond doesn't because they get nationalized. And
that's possible. I mean, certainly one thing that we've learned is that negative interest rates are fatal to banking systems. I mean, that seems pretty crystal clear. Japan went negative a long time ago, and their banking sector on the Tokyo Stock Exchange is down 85% from where it was in 2006, or even 1990 something. And the Europeans, once they went negative, it was hopeless.
The UK's just gone negative, and the 2-year gilts are negative, and the UK banks are at all-time record lows. They've gone below 1986 prices.
I know. It's because they can't possibly survive a negative interest rate. So you mentioned that maybe the U.S. rates go negative. I certainly hope not. Jay Powell says he doesn't like the idea of negative interest rates. I applaud him for that. But because I think if the U.S. went to negative interest rates, I think the global financial system would collapse.
But, don't forget, I mean, I went back and looked at it, and Schatz went negative 18 months before the ECB finally gave up.
Yeah.
Gilts have been negative, 2-year gilts have been negative, and short sterling was negative 6 months before the ECB gave up, the Bank of England gave up. So I kind of think, I don't know whether the Fed gets the choice. Powell can say whatever he wants. The bond market is always, I think, the truth, and it will decide whether it's going negative or not. And I don't know, as you say, what the hell does it do to the system? Who knows?
Well, it's one thing for Japan to be negative and Europe to be negative, but the U.S. is a massive capital market, and at least capital can go to the United States and survive capital destruction of negative interest rates. You don't get much of a reward, but you're not getting destruction. If you start to have destruction in a capital market, the largest in the world by far, I just don't think the system globally can survive.
No, but I think you and I will agree that, okay, so here's a set of outcomes is deflationary, potentially it goes to negative rates. We don't know, but let's assume there's a tail risk of it. Let's assume there's another larger risk of massive fiscal stimulus financed by the central bank. There's also a risk that the central bank buys stocks or go more QE. We go back to the 25% allocation in gold. Doesn't seem so stupid, does it?
I mean, we're starting to get to this kind of 40,000 foot overview type of thing, which is very important. But I've been talking about this. Neil Howe calls it the fourth turning.
That's right. I'm speaking to Neil next week,
and I've been talking the same ideas for a long time. Then I met Neil Howe. It was just remarkable how we had exactly the same ideas, but he was actually much more deep into it. And I realized that we really obviously are going through this, and the institutions are not working. People know that something's wrong, and they know that the institutions are resisting change as they always do because the elites don't want them to change, and yet they're not working. And so it really has to go. So we do have to go through this massive fourth turning of changing the institutions, and obviously the wealth inequality problem has to be somehow addressed, and all of this stuff. And it's the ultimate magnitude of the change, I think, is much more severe, much larger than many people appreciate. And it really is the frog getting boiled in the pot. If you could go back to 1995 or 2005 even, in a time machine and explain to people what the world looks like today, they simply would not believe it.
No way. It would have sounded ridiculous.
It just doesn't seem possible. But it's happening at such a rapid pace. And, it seems and the presidential election is just a microcosm of the whole thing, where, it's just, it's that fantastic, the world really is characterized by this fantastic computer thing where you listen to, two people can listen to it, and one person hears Yanni and the other person hears Laurel. And have you tried that?
Yeah.
You should Google Yanni Laurel.
I've seen it. It's amazing.
It's sort of mind blowing. But it actually has something to do with physiology, about how like sound in your ear or something other. Because I've actually found a way to hear both of them. You have to kind of move around and stuff, and you can hear like Yanni, Laurel. You're like, what? Yanni, and it goes back to Yanni, and it really plays with your mind. But that's a perfect metaphor for how people process what's happening in our world today through current events. I mean, they just simply see something completely different, and it has to get resolved. People have to start seeing things the same way again, and that's the first turning.
Yes, I mean, 100% agree with all of this. It is because it's so overwhelming that people actually just filter out something. So they stick to one truth, and there is no universal truth. We all know that. It's a blended thing, but people can't deal with the magnitude of this, right? And it's very difficult. Those of us kind of slightly burdened with financial markets, because you go and speak to somebody else and you're like, listen, this is really bad, and there is huge change coming. And I don't really know how it plays out, but it's going to get ugly.
I think people in financial markets are kind of attuned to it because it's kind of part of their professional life. If you go to Wyoming, go to Meeker, Colorado, or go to Wyoming, and you will go to these little towns, it's a different world. I mean, they're going through their regular life. They don't watch the news. It's amazing how different life is for those that are in major urban centers or in financial markets, where you're kind of forced to be hyper aware of all of this dissension. And you go to these kind of quiet hamlets, and it feels like it's 1955 or something. And they don't know the magnitude of the tension that exists in the more densely populated urban centers that are, obviously going to have monumental changes in the next 5 years.
So have you caught the Bitcoin bug yet?
Bitcoin? I don't believe in Bitcoin. I actually have made good advice. I've never bought Bitcoin, but I actually recommended Bitcoin twice, and I recommended selling it once, and all three of those trades were really good.
Maybe
I just fundamentally don't believe in it. I think that it's a lie. I think that it's very traceable. I don't think it's anonymous.
But it's not. It's not anonymous. But
yeah,
it's
that was its big allure. Was supposed to be anonymous, and it's not.
No, it is actually a beautifully constructed, pristine asset. It is like gold. It's very divisible. It's transferable. Forget the anonymity of it. Forget that. Because it's fixed money supply, it's the only asset with a purely defined money supply that, its flow versus the stock of it is always diminishing. It becomes extremely interesting as a hard asset.
I don't really have a strong opinion about Bitcoin. I think it's a fantastic trading vehicle.
Yeah, well, obviously you've got the skill for it.
It's got huge volatility. And I've actually been positive on Bitcoin pretty much all year.
My guess is because of your larger big picture construct, spend a bit of time with Bitcoin. I think you're going to like it, because I looked at it and in the end I couldn't find. Now, it's not going to go to zero, but it could fall 50% and never rallies. Fine.
Sure.
But I can't find anything with the skew of risk reward where I'm not paying option premium. There's no time decay. For me, it just, even when I look at, you like charts too, I look at the chart versus gold, chart versus equities, chart versus almost any asset. And it's like, okay, this is breaking out against every single thing on daily charts, weekly charts, monthly charts. I'm like, okay, This is really super interesting.
I hear what you're saying. I'm not at all a Bitcoin hater. It's
just not something you do.
I prefer things that I can put in the trunk of my car. I prefer, gold or really, really precious stones, stuff like that. I believe in that. And they're not terribly liquid, but I like that sort of stuff. I've got quite the art collection, that kind of stuff. And I just enjoy it. I like that more than I don't really need wealth preservation anymore. I just want peace of mind and lifestyle quality. So I prefer my Mondrian on the wall to a digital entry that has the same value.
Yeah, I get it. And why would you not?
Yeah.
Let's say we're in the middle of the fall turning. It should happen because we're at the election point. We've got the big crisis. We've got the debt thing. I mean, almost everything should be in place that Neil talked about, that we've all been looking at. What's the big trade outside of gold? Forget gold. I think a lot of us agree with that. When it comes, and it's these things aren't setting up yet. I don't see it yet.
I like that permanent portfolio concept. I'm going to stay there. I want massive diversification. I'm worried about deflation, and so cash sounds good. I'm worried about the inflationary response, so gold sounds good. I don't like the dollar in any case, and so at a pullback, I would substantially, with a big pullback, I would substantially buy stocks. But at this level, I think 25% is really basically all I can stomach in the stock market. So it's just this kind of four pillared, highly diversified thing. And, the other thing is I feel like we said earlier, the opportunities that are really good are very rare. And I want to have liquidity when the next one comes, because I think it's coming in a couple of years, not 20 years, maybe 5 years at the very outside, but maybe very well 2 years or 18 months. And so the trade is to wait for that trade.
And where do you think that trade's going to come? Is it going to be credit? Is it going to be equity? Is it going to what do you think the trade that's going to set up is? The one that makes I'm waiting for this.
I think equity. But we're talking about a PE in the single digits when it happens.
Yeah.
I turned positive March of 2009 on equities because everybody was so bearish, and the PE for about 2 days was actually below 10 on the S&P 500. Unfortunately, I sold out with about a 50% gain, because it was just too easy. But I think that's coming again, and it will be quite a pleasant experience to not be on in the car on the first hill of the roller coaster that's coming. So I just want to be very low risk right now.
Yeah, and you might be able to make some money shorting it as well if it plays out that way.
Yeah, I probably will short. I don't really want to press shorts right now, but I do think there's a trade on the short side.
Jeffrey, listen, thank you very much for your time. A really great conversation. Thoroughly enjoyed it.
I did too. Thanks a lot and good luck.
Yeah, and you. Take care.
Bye now.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.